Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, like, and hit that bell so you know when I post these videos. On Friday, we set up the kendallreport.com so you can sign up for some exclusive content and a membership that will be sending out offerings and other things that we're planning and doing with our new retail community. We did have an issue on Friday night with the sign up, so if you thought you signed up, please go back and re-sign up and let us know what software platform you use. It'll be critical as we go forward. Thank you so much. After finishing last week up over 3%, markets are continuing on their rampage to the upside. On Sunday, we saw positive activity, and then we're seeing follow through tonight as the S&P has traded above 3,000, as high as 3,012. All of the patterns have turned positive. We penetrated through the 200-day moving average on the E-minis. And as long as these prices hold together, we're likely to close above the 200-day moving average on the cash markets as well. But from a fundamental standpoint, we've got a lot coming out this week, and it's going to be terrible. We have GDP expected to show a minus 4.8%. New home sales down 15%. Permits, everything is going to be terrible that's coming out. Chicago PMI, you name it. All the metrics are terrible. Market participants are continuing to look beyond all that and are looking to the Fed. Their programs they've been running on municipal bonds and corporate bonds are proving to be very effective. We've seen a complete stabilization in those markets. In fact, as you'll see when I review the database tonight, that there's a substantial amount of municipal bonds being signaled to buy. If you recall, Mitch McConnell from the Senate was talking about giving the states the ability to file bankruptcy. While everyone freaked out about that, what did come out of that is that a lot of support for the state. There could be bailout programs to take out some of these really terribly run states. It's unfortunate that they're going to take taxpayer money, but for the most part, this will be fiat currency that they're creating out of thin air. Well, they told us this is what they're going to do. They're doing it, and the markets are continuing to buy into all of this. When I go through the database, you'll see while things are positive, we're still not seeing a ton of rotation that tells us that this is a sustainable trend, but there's certainly more upside in the markets right now. Let's go ahead and take a look at the database and the technicals so we can understand what's unfolding in this very dynamic market. We're going to take a quick review of the database output. Now we continue to see some positive action in the database as there was 844 new buy signals out of our database. I'll go through this in more detail in just a second, but we're up to 37.18% long in the equities. I want you to notice that the ETFs are at 30.68 and mutual funds at 27%. What's happening in the database, there's a leg that's going on with the indexing products, which is interesting because the individual stocks are leading the way off of the low here, and we're not getting a lot of traction in the ETFs themselves. But let's take a look at the sectors on the equities here. And you'll see across the board we saw buying basic materials, cyclicals, energy, some financials. There's not a sector that didn't receive some buys, not a lot, 2 to 3%, but there is buys across the board. When we look at the individual industry groups, then you'll see the same thing. You'll see chemicals and commodities, forest wood products. There's some interesting rotation going on. Whole building is coming back. There was a 23% move there. So there's a lot of things moving around within the database. Now, these are all reflective of individual stocks here. You can see just across the board, there is definitely plenty of activity continuing to come back on in the subcategory exposure, which tells you that the markets are continuing to rotate in a positive mode. As we look at the activity just with the ETFs, you're going to see that the investment exposure has moved up to this 31%. There's not a lot of traction in here yet, but there's definitely some traction coming on. The interesting one is municipal bond funds. This was after comments from Mitch McConnell talking about letting states go bankrupt. There's a lot of talk about stimulus and funds going directly to these states to bail them out. So you can see there's 53.85% of new buy orders, municipal bonds. Looking at the mutual funds, you can see there's very little rotation. We're just not getting any traction. And allocation funds are out, municipal bond funds again. We get into the individual muni funds, you're going to see there's a lot of funds kicking in. Minnesota full on, California intermediate, the long term, you're seeing a lot of positive rotation come in these munis. And the mutual funds have a lot better breakdown than the ETFs do. So this is a pretty important change in the market complexity that's starting to unfold. Now we get down to the large blend. We're seeing large growth starting to kick in. We're looking at right now around 55% of the large growth funds are in. So if you have these in your portfolios, you're likely to see some new buys coming in, or have seen some new buys over the last couple of weeks. This is the breakdown of how the rotation in the database is occurring. Going back up to the top and looking at the rotation, we're continuing to get a fair amount of traction. Looking at the WaveTech research tool, you're going to see that the overall database is now 24.69% long. Now this number needs to get above 42% to actually be a sustainable rally. So we're still not seeing the traction here. There's only one sector long. These are intermediate view, and we're seeing technology is now up. It's only been long for 10 days. It typically holds for 274 days. So there's a long ways to go in this trade. So it's just beginning, and we're not seeing any more traction on any of these sectors, which tells us there's so much work yet to be done for a sustainable rally. There's a lot of stocks that are driving the indexes higher. We're not seeing the overall database from a sector by sector basis get traction just yet. So this thing is very suspect from the standpoint of a longer term rally. So we're just looking at some point where it's going to get a little overdone, and there will be some backfilling of this trend that we've been watching unfold. I just want to make a quick comment about the market grid for Tuesday on the cash markets. Now we're trading above the extremes already. The reason why this has happened is the futures grid has been updated, so you can look at that. It's posted on Twitter as well as on the community. I will also put this graphic in the community, but you're going to need to look at the resistance numbers on the weekly for today's action. 3018 is a key resistance point, and above that level, then it's 3045, 3052. So just make sure you understand you want to look at the weekly projections today, because most likely we're going to see this penetration of the extreme. Now, it may come into play where these numbers at 2985, 2978 may be support if we see a turnaround in the market. Beginning with the S&P futures, they're trading up above the 200-day moving average, which is currently 2992.53. We're trading at 3,000.75. If we look at the market grid on the left, you'll see that R1, resistance 1 is 3,050, which is right where we're trading at these levels right now. So you want to watch for reversals from this level, but momentum tells us that this market is going a lot higher. We're seeing some extreme momentum build on PPM1 now at 0.51. On Friday, did get a confirmation buy on the daily INX, the cash, and we're starting to see this acceleration moving above this 200-day. Now, I did frame that we needed to close over the 200-day by Friday or it would be doomed, and this is not the case. We closed very strong on Friday. We finished a strong week up over 3%. Now we're seeing the follow through overnight. And there's a number of things going on the planet that maybe make sense to some and don't make sense. Every old guy, including me, has been telling you that the fundamentals will come into play, and they will. We won't continue on this path that we're on, just defying gravity, but there is a lot more to go. And there's a couple new objectives that I want to talk to you about short-term level that is very possible. There is some resistance at 3003. You'll see it on the high target. Now this is a different indicator. This is the Fibonacci indicator, and it's showing that the first target was 2936. We went through that a couple of days ago, and now we're at 3003, and the next level is 3045. And we'll see when I go in the weekly charts, you'll see the estimates for this week will indicate that there's a potential for much higher prices in this pattern. And once we get over the 200-day, not that it's the end all, but it is important to the pattern because it's being watched so carefully. So it does appear, based on momentum on ppm1 being at 0.51, ppm2 0.22, and ppm3 0.35. These are all very positive trend modes suggesting this thing's go higher. As I mentioned a minute ago, the cash got a buy a couple of days ago. Futures still have not issued a buy, but they're likely to do so after the close tomorrow if we can hold these prices. I've taken off the market grid for the moment just so we can get a cleaner look at what this market's doing. So you can see we've hovered underneath this 200-day moving average. I did answer some questions that were on the channel talking about why don't I use the exponential averages instead of the simple. And just a quick answer on that is that the problem with exponential from my viewpoint and the WaveTech process was developed on simple averages because it helps to define patterns. You can see this 21-day moving average, this blue line where my cursor is here, was the top of this pattern here, and then we got the crossovers, and we can see there's resistance points, and it helps to define patterns. So the WaveTech concept is about patterns and understanding those patterns. If you use exponential averages, when the market starts to go sideways, they converge substantially, and it doesn't give you that same pattern recognition where the pattern is likely to trade in and out of. You'll hear me talk a lot about the patterns, or will be sandwiched between these moving averages, and I've been using these same moving averages since 1986. And that's the thing I always suggest to all traders is find out what works for you and then follow it, and don't leave that strategy once it's proven that it has validity. And trust me, I have done this so long, I understand how this thing's going to work and what it's likely to do. Looking at the weekly futures, the ranges of expectations, I talked about the upward target of 3045. You can see on the grid on the left here that the resistance 2, or R2, is 3032, and then above that is 3074, all the way up into the 31 handle. I'm not sure we're going to get that high, but we certainly can trade at 3032 and possibly get up to that 3045 level, no problem, with the kind of volatility that we're dealing with. Notice the ppm is just exploded. I talked about this last week. It is now at 2.60. The ppm2 is still negative, but it's only negative by 0.36, and ppm3 is now turned up. So you can see we're starting to cross over all the first derivatives. These are all in positive slopes, and this move in the 10-period moving average, this is huge. So this is telling us that there's an absolute floor, 2803, 2840. We're not going through that level no matter what. We're not going to trade there right now. I'm just saying that that is where the major support is in this market. Resistance is up at the upper levels that we see here, 3032 and 3074. That's most likely going to be the extremes for the week. Taking a quick look at the gold chart, we're sandwiched in this range that we've been locked in for a while, which is between 1765, 1721 level. We're currently trading at the upper end at 1754. You can see R2 is 1758.60. We're going to see some resistance there, and above that 1765, 1771. So we're still locked in this range. We're not seeing any acceleration to speak of in the ppms, which tells us we're not going to break out at this time. The one chart that is bullish is when we flip this over and look at the weekly chart. Then we start to see a much more positive pattern. And looking at this chart, the ppms remind me a lot of how the S&P is set up. So it looks like the market goes higher, gold's going to move back up into its upper end of the range. As we look at the weekly graph, you're going to see the upper end of the range is 1768, 1784, and then 1800, and slightly above that. Look at the market grid on the side is the 1814 level as an extreme for this week. So we're still locked in a sideways range, but we're seeing this sawtooth formation, and we're probably 1 to 2 weeks from breaking out. Still bullish on gold. As we take a very quick look at the monthly graph, you can see this pattern continues to be very bullish, but it's also projecting a higher range. You can see R2 is 1814, which is similar to the weekly extreme, and then above that 1867, 1900. So this market is going to stay positive for the balance of this month. There's not much left of it, but we're going to see it move up potentially toward that 1760 level. And looking at the shorter term charts I just covered, that fine tunes the range much better. The last market we'll take a look at tonight is the crude oil. It has moved up to the 34 handle and continues to be very positive, with ppm1 a plus 2.57, ppm2 plus 2.90, and a plus 6.2. So all the moving averages are confirming that crude oil is in an uptrend. Looking at the market grid for crude oil, we're trading at R1 right now at 34.23, last 34.22, the high has been 34.25. Above that level, next level is 34.79 and up into the 35 handle. I suspect that we're going to move toward this 200-day moving average back towards 42 to 46 as the country starts to come on, as people change some of their habits, as we see an increase in driving and other activities, including airlines. We're going to see crude oil continue to be stronger. I understand that the fracking units are down about 17-18%, so that's helping. There's been some wells shut down, so that's helping the supply, and so we're going to continue to see some positive action here. There's nothing like America. It's hard to stop Americans. So what we're going to see here is a continuation of the opening of America, the demand on oil. This will complete this broadcast. Remember, on Wednesday at 1:30 Eastern Time, I will be doing a live cast. Looking forward to answering your questions and going in much more depth than I do in these videos. Thanks again for watching. We'll talk to you tomorrow night.